Yo, what's up, everybody? It is Thursday, December 22nd. The bomb cyclone hitting across most of the USA. Right here in New York City, we got heavy rain coming down, but I guess lots of cold air throughout the USA and a lot of snow. So the media has been pumping that up like crazy. I don't know where you guys are, but hopefully you're not getting hit too bad. All right, so today was a rough day. I mean, we were down at one point. The Dow was down like almost 800. We ended up recovering about half of that by the close, so that was a nice recovery. What can I say? Today's initial selling was really triggered by third quarter final revision. Final revision of third quarter GDP, which came in higher actually than the earlier estimates. It came in at 3.2%, and the earlier estimates were at 2.9%. So, that's a positive revision. It's something that I've been citing as the economy is back in expansion. We're going to have a positive GDP growth in the fourth quarter. By the way, yesterday, the chart I showed you of daily employment and withholding tax deposits and how that has really surged recently, like over the past month, I think that is suggesting a very strong labor market right now, decent wages. So we're going to get a strong job report in January when we see the December job report. And I'm going to talk about that in another context in a second. But yeah, today's initial selling was triggered by a stronger final revision of third quarter GDP. And again, this is an example of, the zombie monetarist behavior when they're selling good economic growth. I want to tell you, and I've said this before, that ultimately in the big picture, stocks will follow the trajectory of the economy. It's not the other way around. A lot of people think it's the other way around, that the stock market leads the economy. That's not the case. The reality is the economy will lead the stock market. If the economy is expanding, that will translate into higher corporate profits, higher incomes, and that's a positive thing, and it will be reflected in higher stock prices and vice versa. If the economy is contracting, then we will see contracting corporate profits, we will see falling earnings, falling wages, and so that will, be obviously a negative situation. So these numbers, they're clear and they're obvious. The first half of 2022 we had 2 quarters of contraction, and that was entirely due to the unprecedented, the historic contraction in fiscal support. I spoke about that yesterday, and I've spoken about that many times. We saw almost a 2 trillion subtraction from the financial balances of the economy as a result of cuts to the fiscal support and higher taxes. Taxes weren't actually raised by Congress, but remember, we were paying taxes on income earned in 2021 when the economy was growing at a much faster pace. And then this year, fiscal support was lower, so proportionately more taxes flowing out, and that was the result. That resulted in that big contraction in, fiscal and the deficit. But the second half, now we're starting to improve, and that's going to continue. As I said, I see that continuing through next year. As a matter of fact, accelerating. And I think I'm the only one out there, because I have not seen anyone else who's saying there is no recession in 2023. It's almost universal that the forecast is for a recession in 2023. I say that's not going to happen, and I've given you my reasons why that's not going to happen. Now, the other day I said the one thing that concerns me is the debt ceiling. We had some progress, not necessarily on the debt ceiling today, but on the that big 1.7 trillion spending bill in Congress. It passed the Senate. It goes on to the House tonight. Hopefully they can pass that thing. If they pass that thing, that's a good, that's a good development, because we'll finally be getting off of these short-term continuing resolutions. These continuing resolutions, whenever Congress passes these continuing resolutions just to, to keep the government running for a short period of time, they don't contain any spending increases. They basically just continue what the prior spending levels were, just so they keep things going without having to shut the government down. This omnibus spending bill, this new spending bill, will raise, there's things in there, obviously, like there's that defense budget that I spoke about, that's a big one, and there's other elements in that bill that there's more money for Ukraine, okay? And there's other elements in that bill that are going to add to overall spending total. So I think that's positive. But what we're still dealing with, and by the way, I want to add one more thing, that the selling I said was triggered by the better than expected GDP number. And again, to me, that's just an irrational, that's the monetarist psychosis. Like, the economy's doing well, we better sell the stock market because, oh my God, it means the Fed is going to raise interest rates. I mean, we've been through this like a million times, and it's, this is the reason why the recovery in the stock market is taking so long. I mean, you're fighting against a mindset that is deeply, deeply embedded, and it's like a belief system that views what the Fed is doing with respect to monetary policy as extremely, extremely negative. All right, this is the one variable analysis that I always talk about, and it's a one variable analysis where that one variable is really not fully understood. It's as if these people are saying price changes initiated by the central bank are the only factor that impacts the economy. All right, because instead of saying rate adjustments, let's just say price changes, because that's what they are. I mean, rate increases, they increase prices, rate cuts decrease prices, okay, generally. So price adjustments or price changes initiated by the central bank are the only factor impacting the economy. That's basically what they're saying. It's not fiscal, it's not trade, it's not, let's say, energy policy that is sort of controlled or dictated by an external factor, a cartel, none of the other things. It's only, this is their belief system, that price changes, and if you think about it, it would be incredible if that were true. I mean, for 50 years, basically, we've handed over the responsibility of managing the economy to the Fed, the central bank, under this idea of monetarism, where all it takes is for the central bank to adjust price levels via the rate mechanism, and we could manage the economy. And if you don't see by now how ridiculous that belief is, how ridiculous it is to assume that is, something that is valid and capable of delivering the result, that I don't know what else to tell you. I mean, how many times in the past, just like in the past 20 years, has the federal government had to step in at times when, we hit the skids, when there was some kind of crash, when there was some kind of implosion in the financial system. I mean, that was the only really buffer, that was the only really mechanism to bring things back to an equilibrium. But we're still running under this false belief that all the central bank has to do is manipulate, one particular price level, the interest rate, and everything will, come back to a very calm equilibrium level. I mean, it's completely ridiculous, but this is what's in their mind. This is what's in their mind. So we're fighting again. The market, the reality is, and I hate to say this because it's just, this is what's making it difficult. This is what is making it frustrating, okay? I mean, I come on here every day and I say, look, this is happening and this is happening and this is happening. I show you the data. I'm saying fiscal expansion, income transfers into the economy. The swimming pool is filling up. All those things are very, very important and valid points, and they are, as I always say, that's the first derivative. But you have this resistance against that because there's a mindset which is universal. I mean, everybody. The only place you're getting a different point of view is right here on this channel when I talk to you guys about it. And a lot of you, now you guys understand it because you've been listening for a long time, and the light bulb went off in your brain, and it's like, yeah, I could see that. I can understand that. But we're fighting against a mindset which is like a kind of a resistance factor. So like every time we're going to see positive economic information, there's going to be this triggering effect that's going to cause people, this whole monetarist world out there, this belief system, to want to sell the market. You have to just be disciplined about this and understand that now's the time to really stay focused forward, in a forward fashion. Think ahead. The big money is not made, believe me, the big money is not made by selling these dips. I've given many examples of my days, or many, anecdotal stories of my days on the trading floor when I spent most of my time trying to short the market. And it was like kind of this strange behavioral thing in the trading pits where most of the traders in those trading pits, for some reason or another, I have no idea why, and I always said you could do kind of like a psychological or a sociological study on this. It could be a great PhD thesis, like why did we always want to sell? We were always trying to go short the market. And then in every pit that I traded in, and I was a member of 4 different exchanges, okay? But in every one that I traded in, there was always one guy, maybe 2 guys sometimes, but usually just one guy who was the biggest trader, who made the most money, and he was buying all the time. That guy was buying all the time. And it never kind of clicked off in my head, like, kind of connect the dots. Like, he's the biggest trader, he makes the most money, and he's buying all the time. I never even took a minute to try to analyze that or understand why. I just kept on doing what I was doing, and so did everybody else in the pit. It was like a frenzy. It was like, if you think of the ocean, and then there's these great schools of small fish, right? And they're all swimming around and they're all doing the same thing, and their movements are very frenetic, and they're kind of, they're herky-jerky. They go one way, they go another way. Anything could spook them. And then, here comes the killer whale or the great white, the lone, coming in, gliding through the water, confident, just, absolutely looking at this school and thinking he's just going to devour them, in massive gulps at a time. And that's what it was like, man. It was really like that. Like, we were all sold every opportunity to sell. If it went up, we were selling. If it went down, we were really selling. We were selling into the hole. And then there would be that one guy who would just stand up and, like, I'm buying, I'm here, I'm taking everything you want to sell. And he would take it even from the big, brokerage houses. I mean, some of these brokerage houses, and I knew some of these guys, and some of the brokerage houses actually employed pit spotters. Those were people, they weren't even traders. They would stand in the pit just to relay upstairs to the big Wall Street banks what this guy was doing. What's he doing? What's he doing? Think about it. I mean, you literally there was a famous guy, Tom Baldwin, in the Chicago Board of Trade, in the bond pit. You think about that. In the Treasury bond futures pit, the Treasury bonds, you're talking about U.S. government bonds, this is a multi-trillion-dollar market, the biggest in the world, the benchmark for all other interest rates in the world. And here was this one guy standing there, Tom Baldwin, and you had all these spotters in the pit. Spotters working for Goldman Sachs and JP Morgan and Citibank and Solomon Brothers at the time, and you name it, the biggest financial institutions in the world. What's Tom Baldwin doing? You could just imagine up at these trading desks on Wall Street, the masters of the universe sitting at their desks, they're all calling down to the pit. What's he doing? What's he doing? He was buying. And we had another guy like that in the S&P pit. It was really something else. But I never tried to connect the dots and think about, well, why are they doing that? Maybe I should do the same thing. No, it was like I did what everybody else was doing basically, and we were all selling every opportunity we had. We were selling. We were selling constantly. So, I mean, I deviated a little bit off of what I wanted to say, but what I wanted to say is now's the time you have to look past this behavior. You got to think about the big picture. I'm telling you this right now, the big money is going to be made when this thing starts to go back up, and it will go back up. And this is not a single variable reality where everything hinges off of interest rates and solely through a one-directional view of interest rates. In other words, the view when it comes to interest rates is that it's just a negative thing if they're raising them. No discussion ever of the interest being paid into the economy. I gave the example once before, maybe several times before. Interest was the biggest line item of expenditure during the Reagan boom in his first term. Nobody really talks about that. They talk about defense, maybe the tax cuts. Interest income transfers into the economy were the biggest line item of the government spending during the Reagan boom. Remember, that's when Volcker jacked up interest rates to 20%. No discussion is ever had when it concerning that aspect of interest rates. It's always a negative thing, and you're gonna get this behavior triggered off of every time like today. You get a better than expected 3.2 GDP growth. That is damn good. Okay, that's good growth, and they sell. It's not gonna work. It's not gonna work. So if you're like I said yesterday, if you're really short-term oriented and you want to try to jump around with this stuff, I mean, that's up to you. If you have a strategy for doing that, I have never really, I made money, I lost money, I made money with strategies like that. It wasn't something, and I said this yesterday, you can't scalp. And especially nowadays, yesterday I was talking about how you couldn't beat me. I was a floor trader and I had instantaneous access. I wasn't paying any commissions, nothing well, now there's no commissions. And as fast as electronic trading is, I gave the example yesterday, I saw the broker running into the pit. I could see his face. I could read the emotion. I knew what he was going to do. Okay? But even, let's say today's electronic trading is even better. you're not going to beat the algo guys, who literally, they are set up to read the order flow before it even hits the exchange, okay? Their computers and their algorithms, they see that order flow coming down the pipe and they jump in front of it. That's like insider information. You cannot beat that. All right? You cannot beat that. So why play that game? Right? You want to play your own game. And your own game should give an advantage to you. Don't play somebody else's game. I mean, to me, that's just logical. Like, don't play somebody else's game. You're not going to be as good as that person or that entity or that firm that set the game up in a way where, they basically, I don't want to say they can't lose. They do sometimes, but they have, it's like a casino, right? A casino has a probabilistic advantage over the customer. I mean, all you have to do, you go to Vegas or anywhere where there's big casinos and you see these multi-billion-dollar casinos. How do you think they pay for those casinos? How do you think they get a return on investment? I mean, most of that comes from, you know where it comes from? It comes from the slot machines. That's why they build these enormous gaming floors and they just fill them up with slot machines, and all of those slot machines are programmed to have a small advantage, and that's all it takes, because over tens of thousands, millions of events of people pulling those levers, that small advantage adds up to those billions that fund the building of those casinos. And that's exactly like, if you try to play that game and you're going and basically that you put yourself up against these firms that run these algo things who are able to jump in front of orders. I mean, it's like you going into the casino and playing the slot machines. Yeah, you're going to win every once in a while, and you're going to think, oh, this is great. Look, I just won. And it's actually designed that way, to make you win a little bit once in a while, because that keeps you playing, and that's just going to deplete your money. Play a different game. Don't play the casino's game. Play your own game. Like, this is one thing I admire about Warren Buffett. He plays his own game. All right? And we've seen the big declines recently in some of the richest people, like Musk. He's not number one anymore. And, Facebook guy, Zuckerberg, he tumbled way down, and et cetera, et cetera. But who's still right up there? Buffett, man. He plays his own game. So that's my advice for today. Play your own game. Look past this stuff. We're still gonna get a lot of this behavior. But focus on what's important. The stuff I'm telling you now. The first derivative, the core, these flows, the swimming pool. It's not easy sometimes. Today I was pissed off looking at what happened. I mean, just like it angers me. It gets me frustrated when I look at this kind of behavior, and I'm thinking, like, this is just stupidity, man. But you got to look past it. Anyway, that's it for today. See you tomorrow. Bye.